Okay, good afternoon, everybody. We'll go ahead and get started here. Thank you again for joining us for this afternoon's webinar, an introduction to impact investing for institutional investors. My name is George Dyer. I'm a principal with the Intentional Endowments Network, and I'm very pleased to introduce our excellent lineup of panelists today. First, we'll hear from Fran Siegel, who's the Executive Director of the U.S. Impact Investing Alliance. We'll also hear from Allison Spector, Senior Manager, Investors Council and Membership Programming at the Global Impact Investing Network. And finally, from Sean Wishmeyer, who is the Chief Investment Officer at the Margaret A. Cargill Philanthropies. So after a brief presentation from each of our panelists, we'll spend the remainder of the hour in dialogue with our panelists and hearing questions from all of you. So please do enter your questions throughout the program through the chat function, and we will look to address as many of those as possible after the presentations. This webinar is being recorded and it will be on our website shortly, so you'll be able to refer back to this conversation, and we will also make the slides available upon request. So next slide, please. Just before we get started, for those of you who are not already familiar with the Intentional Endowments Network, we are a nonprofit peer learning network designed to support endowments in enhancing investment performance by aligning investments with institutional mission, values, and sustainability goals. And we do this in a variety of ways, including hosting in-person forums and meetings, facilitating peer networking opportunities, curating useful resources on sustainable investing, and providing educational venues such as this webinar for investors, asset managers, consultants, other stakeholders to connect and learn from one another. So we encourage you all to stay engaged in these conversations after today's webinar. If your organization is not already a member of the network, we'd encourage you to consider joining. It's a great way to demonstrate your organization's engagement and leadership in the sustainable investing field, and a critical part of making these types of opportunities possible. So with that, I'll turn it over to our first speaker, Fran Siegel, who will provide an overview of impact investing and the work of the U.S. Impact Investing Alliance. Fran?
Thank you so much. Good afternoon, everyone. Welcome to the webinar. I will be speaking first about impact investing, both the state of the field and the drivers of growth. But before I dig in, I wanted to share just a little bit about the Alliance, which is a relatively new group. Our mission at the U.S. Impact Investing Alliance is to partner to catalyze a movement that will transform finance by putting measurable social and environmental impact, as well as risk, at the center of every investment decision, along with risk and financial return. Specifically, the U.S. Impact Investing Alliance seeks to increase awareness of impact investing in the U.S., foster deployment of and demand for impact capital across asset classes globally, and partner with stakeholders, including government, to build the impact investing ecosystem. The U.S. Impact Investing Alliance is being incubated at the Ford Foundation and is supported by a broad range of philanthropies and other donors. Next slide, please. So traditionally, our world operates in somewhat bifurcated fashion. So we have the private sector, the capital markets goal of maximizing profit or maximizing shareholder value, perhaps without regard to social and environmental impact. And then we have the philanthropic or public sector's goal of creating social and environmental impact. And in many respects, and at least traditionally, these spheres were mutually exclusive. So you would make your capital, whether you're a business or an individual, or even a foundation, you'd engage in your investment or business activities, and then ex post, you would engage in public sector engagement and philanthropy. Next slide, please. Actually, one more, if you could advance one more. Perfect, thank you. So there are a set of global factors that have begun to challenge this bifurcated view and creating opportunities for an openness to simultaneous returns, financial and impact returns. So I'll just share a number of them, or a few of them with you today. So demographers predict that the global population will be about 9.7 billion in 2050, up from about 7.5 billion now. So extraordinary population growth over the next couple of decades. most of the population growth will occur in emerging markets, and we will need to increase food production by over 50% to meet this demand. And there are attendant other kinds of increasing demands for education and health and housing. So too, on the environmental side, there's climate change, dwindling natural resources, water security issues. And so the world is changing in a very meaningful way. At the same time, there is a growing dissatisfaction with the short-termism of Wall Street, again, maximizing shareholder value, perhaps without regard for a broader approach of stakeholder value. And there's also an increasing impatience with traditional models of philanthropy, which is also bifurcated traditionally, wherein the grant-making budget is about 5% of the foundation's endowment, and the 95%, the actual corpus of the institution, may unconsciously be invested at cross purposes to the mission of the organization. And if you have 90% of the capital invested unconsciously without regard for impact, and 5%, no matter how effectual the 5% grant making is, you are likely doing net negative mission impact. And so foundations, university endowments, pension funds, and others are starting to take a closer look at how their endowments are managed. So these driving forces, these demographic, psychographic, environmental, and regulatory, I'll talk a little bit later about policy, regulatory forces, but just the kind of impatience with traditional models of philanthropy, as well as frustrations with the short-termism of Wall Street, are drawing these spheres of profit and impact together. And at the intersection of these two spheres, we have impact investing. Next slide, please. One more, I think. One more. Yes, thank you. So just to level set for the purposes of our webinar, and I know that Allison from the GIN will speak next, and we're in very close alignment about these definitions, in part because they're taken from the GIN, among other venues. So impact investing aims to solve social and environmental challenges while generating financial returns. Impact investing can be expressed across asset classes, from cash to the public stock and bond markets, to the private markets, including private debt, private equity, and real assets. The impact must be intentional and not incidental. On the public market side, the impact can be expressed through the integration of environmental, social, and governance factors, the acronym that we use, ESG. So factoring environmental, social, governance factors into investment selection. And this is in contrast to what I would call socially responsible investing 1.0, which is really about negative screens, so screening out the sin stocks and the roots there with religious investors from the 17th and 18th centuries. And over the period of years, we've evolved to more positive screens, as well as this ESG integration. So that's how you might express impact through a public market or public security portfolio. On the private market side, investment themes or impact themes might include financial inclusion, including microfinance, sustainable agriculture, health, education, energy, and water. So just to give you a feel for exposure across asset classes. The financial returns of impact investing can range from a return of principal to market rate or even above market rate returns. And I'll speak in a moment about some of the research that has been done about financial returns in the impact investing sphere. And then finally, Monitor Institute wrote this very seminal report in 2009. I think it was right around the time that the first GIN report came out with JP Morgan, talking about impact investing as a market. And this frame of impact first and financial first is still somewhat used today. Impact first investments, we're seeking to maximize impact with a financial returns floor, implying a concessionary return, financial return for the risk. And financial first investments, we're seeking to maximize financial return, but with an impact floor. And I think that that is still in some ways a frame that is used when we think about impact investing. But I think those of us, the practitioners in the field, feel like that is a somewhat reductive framework because it implies a trade-off between financial and impact returns, and that is not always the case. I actually read a blog post a year or two ago I coined this kind of term impact unicorns, saying that there are times where you do need a trade-off, but there are some types of investments that you can make that where the financial returns are made because of, not in spite of, the impact thesis. And so that's how I was describing kind of having your cake and eat it too. So it's a nuanced conversation. I think that, you know, folks who say you can always have your cake and eat it too, I don't believe that that's right. I think it's a very nuanced aspect of our practice. Next slide, please. So the U.S. impact investing industry has been growing, and Allison from the GIN will talk a little bit about their primary data, which is global in nature. According to a biennial market sizing report by U.S. Social Investment Forum, about 8.7 trillion, or 1 of every 5 investment dollars in the United States, is invested with impact. That includes these so-called negative screens that I mentioned earlier, as well as environmental, social, and governance integration, ESG integration, around the public markets. It also counts shareholder resolutions, and so that is where shareholders express their desire for engagement with management and changing practices around, say, the environment. And there was kind of a couple of shareholder actions and proxy votes around Exxon and Occidental Petroleum that captured headline news. So I would say in these numbers, there's like a slice of community investing, but for the most part, it is primarily driven by the public markets, and I'll let Allison talk a little bit more about the private markets in a second. Next slide, please. Yep, so just sharing this landscape here that was developed by the Rockefeller Foundation, merely to show that impact investing is a global movement across developed and developing markets. And the actors who play in the impact investing ecosystem are broad in nature. They're asset owners, so investors, intermediaries like investment banks, broker-dealers, deal platforms, asset managers who manage product or develop product and manage assets, and then companies themselves, as well as ecosystem enablers who address impact metrics measurement and reporting, policy, legal forms like corporate forms, and data research and education. Next slide, please. Okay, so incumbents are entering the impact investing market, largely at the behest of their institutional and high net worth clients. So as I mentioned earlier, institutions including foundations, university endowments, and pension funds are increasingly engaged in impact investing, interested in it. On the high net worth side, and not actually on the high net worth side, on the individual investor side, there's a $40 trillion wealth transfer coming over the next 30 to 40 years as baby boomer males pass. So first the capital will go to women and then to millennials. And we know from research from both Morgan Stanley and US Trust that roughly 2/3 to 3/4 of women and millennials are interested in investing in alignment with their values. And so this is a huge, it won't happen overnight, but this is a huge wealth transfer, and we hope a transfer to investing with values. So asset managers, like incumbent asset managers, the biggest, like BlackRock and TPG and Bain Capital, have taken notice and are developing both public and private product offerings to meet the demand. Intermediaries like Goldman Sachs, Morgan Stanley, and Bank of America Merrill Lynch are taking buy or build strategies to meet the interest of their institutional and high net worth clients. I would also say that policy is a driver in a range of ways, but in particular here we're talking about a modernized concept of fiduciary duty. So in the Q4 of 2015, the IRS issued guidelines for foundation fiduciaries, and the Department of Labor issued a bulletin for ERISA-regulated pension fund fiduciaries, allowing them to take impact factors into account when making investment decisions. And there was some acknowledgement, especially from the Department of Labor, that impact factors may mitigate risk and drive returns. And so these are, big factors, policy, incumbents making the move. And of course, there are also a ton of pure play actors, both fund managers and intermediaries alike, who are entering the field. Next slide, please, and then I'll wrap up. Actually, I think I have 2 more slides. So just a little bit more digging a bit deeper on this financial returns piece. So I'll give you a slide on public market returns, financial returns and impact investing, and then one on private. So in the public side, we have strong evidence to suggest, that environmental, social, and governance companies or companies that manage to around environmental, social, and governance factors can meet or exceed the performance of the standard benchmark. So Morgan Stanley conducted a study of over 13,000 mutual funds and separately managed accounts over the last 7 years. And they found that investing with impact typically met and often exceeded the performance of comparable traditional investments on both an absolute and risk-adjusted basis across asset classes and over time. The University of Oxford has done a meta-study of over 200 studies that had similar findings. HBS has done some really interesting work in that regard as well. And just yesterday, actually, in the New York Times, Andrew Ross Sorkin of the New York Times wrote on the front page of the business section about a Bank of America Merrill Lynch study that looked at ESG performance and found that stocks in the highest quintile for ESG performance had the lowest earnings volatility in subsequent years, and their share price outperformed the basket of stocks with the lowest ESG ratings. So starting to get some really great hard data on financial return and how the management of environmental, social, governance risk and return can actually dampen volatility and perhaps drive performance, financial performance. Okay, my last slide is around the private markets. So here, data is increasingly demonstrating that private equity impact investments can meet and in some instances also exceed the risk-adjusted market rate of return. Cambridge Associates and the GIN founded the Impact Investing Benchmark in June of 2015, which was really a landmark for the field to have Cambridge Associates and the GIN partner in this. They conducted a study of 51 market rate global impact venture funds from 1998 to 2010. And which was actually a very tough time for the standard Cambridge Associates venture capital benchmark. And they found that funds typically kept pace with the comparative universe. For some vintages, some smaller funds, emerging market funds, and specifically those focused on Africa, interestingly, actually outperformed the returns of the comparative universe. Around the same time, the Wharton Social Impact Initiative conducted a study of 53 market rate global impact venture funds, also came out in 2015. And they found that the market rate impact venture funds can achieve risk-adjusted returns as well. So there's much more to share, obviously, about the state of impact investing, returns, impact measurement, et cetera, but I'll pause here and actually hand the baton to Alison Spector of the GIN.
Great, thank you so much, Fran. That was a really helpful overview. And just to remind everybody to please do enter your questions at any time through the chat function so we can get to those after the presentations. And now, Alison, take it away.
Thanks, George, and thanks, Fran. It's great to be here with all of you. We're really pleased to see so much interest from the endowment community in impact investing, and we're here today to provide an overview of the industry based on our experience, the Global Impact Investing Network, as the de facto industry association for impact investing, and as Fran mentioned, also based on some of the primary data that we collect on this industry that informs in some part some of the findings that Fran mentioned. My name is Alison Spector. I'm a senior manager here at the GIN, and I'm also here with my colleague Hannah Schiff, who's a manager on our research team. We'll hope to answer some of the questions that you also submitted about impact investing. Next slide, please. So as you might know, the GIN is a nonprofit field-building organization that works with investors, asset managers, and other service providers to build the market for impact investing globally. And we do this in a number of ways that you see here. I won't go into detail on all of these today, but I do encourage you to check out our website to access more impact investing resources, including those created by others in the industry that Fran mentioned. And also consider joining our membership, which is the largest community of impact investors globally at over 250 organizations. And we're excited that we've recently partnered with the Intentional Endowments Network to help channel some of our impact investing resources to your community in hopes of broadening the set of actors in the impact investing market, and also being able to leverage and learn from your own experiences as responsible investors. Next slide, please. And so I'll reiterate the definition of impact investing. I know that was some of the questions that we received from participants. So again, the GIN defines impact investing as any investment made into a company, organization, or fund with the intention to generate social or environmental impact alongside a financial return. And impact investments can be made in both emerging and developed markets across asset classes, including listed assets, and target a range of returns from below market rate to market rate, depending on investors' strategic goals. And you'll see some of the other characteristics we've listed here, which obviously are in line with those that Fran also presented. Next slide, please. And we at the GIN generally view impact investing as distinct from ESG, but as a complementary strategy. In our experience, investors are drawn to impact investing because it enables them to see how their money is having a direct and measurable impact through specific projects. And by contrast, we see the effect of other responsible investment categories tends to be more indirect and therefore more difficult to measure. And many investors pursue impact investing, as I mentioned, as a complementary strategy to ESG because it allows them to create impact and deep impact, as Fran has mentioned, and also to create additionality. And I'm sure Sean from the Margaret A. Cargill Philanthropies can bring this to life when he speaks about their impact investment strategy. Next slide, please. And so to show you how this plays out in practice in the marketplace, we'll share a few data points from our most recent Impact Investor Survey, which is now in its 7th year and available online on our website. And the data actually covers both public and private markets. We had 209 respondents this year, making it the most comprehensive data set that exists on the impact investing industry. And all of the respondents are active impact investors who must meet at least one of two criteria to participate. So either they've committed at least $10 million to impact investments, or they've completed at least 5 impact investing transactions, or both. And for starters, as you see on this slide, respondents are based all over the world, with a concentration in the US and Canada, as well as in Western, Northern, and Southern Europe. But there's also representation from a variety of other regions in the world, like Sub-Saharan Africa, Latin America, and others. Next slide, please. And collectively, they manage nearly $114 billion, and in 2016 committed more than $22 billion. And most investors plan to increase that activity in 2017, this year, with an aggregate increase expected at 17% to nearly $26 billion, showing clear signs of optimism. Next slide, please. And this capital is allocated all over the world, about half to developed markets and half to emerging markets. And a quick note on the next few graphs here, we have a few large and concentrated outliers that account for about $50 billion of AUM in the sample. And so to show a more representative picture, on the following slides, the dark blue bars on the bottom are the figures that exclude the outliers, and the height of the light blue bar includes them. Next slide, please. In addition to geographic diversity, impact investors are active in many different sectors or impact themes, as Fran mentioned. And here, this slide shows you the top sectors of focus for the impact investor respondents. And you can see here a main focus on providing access to basic services like housing, energy, microfinance, as well as other financial services. Next slide, please. And impact investors also invest through many different financial instruments and in many asset classes. And the AUM of our sample, as you see here, is concentrated in private markets, primarily private debt, private equity, and real assets, though we are seeing increasing interest, of course, in the public markets as well. Next slide, please. And impact investing strategies also vary by types of target return sought. And this, again, is a unique feature of the impact investing market. So about 2/3 of the respondents in this survey target risk-adjusted market rates of return, with the rest split between those intentionally targeting below market rates of return that are either closer to market rate or to capital preservation. And in terms of risk, by and large, most respondents have not experienced a major risk event in the past year. And those that have point to common sort of macro issues that actually affect any type of investment, not just impact investing. Next slide, please. And across the board, impact investors are satisfied with their returns, which is a great thing to see. A majority of impact investors have said that their portfolios are either performing in line with or exceeding their expectations around both impact and financial returns. Next slide, please. Now, I want to share some data about the fund managers in our sample who represent a majority of the respondents. Like in other areas of finance, intermediaries or fund managers play an important role in impact investing, often acting as the bridge between asset owners and investment opportunities. And in 2016, 101 fund managers in our sample raised more than $11 billion, and they plan to grow this by 67% this year. Next slide, please. And we asked these fund managers about their sources of capital. And by volume of capital, the largest source are institutional investors, so pension funds and insurance companies, at 24% for the whole sample. Next slide, please. And we also asked fund managers about the levels of engagement they see from different types of investors, foundations, family offices, banks, sovereign wealth funds, pension funds, and insurance companies. And the darkest blue bar here shows the number of fund managers that said most investors they interact with were already allocating capital to impact investments. And then the next share are those investors that are developing an impact investing strategy, followed by those investors who are starting to consider impact investments. And then the lightest shade is the percentage who said that most investors of this type were not interested in impact investments. And so I think you'll see that the key takeaway here is that there's lots of engagement and interest from all investor types, foundations and family offices, as you might expect, but the others are also at least considering impact investments, if not actually already allocating capital or developing their strategy. Next slide, please. And so as you might know, there have been an increasing number of large, and as Fran called them, incumbent or well-known asset managers and other financial firms entering the market. And while, as the first bar shows, many respondents think there's a risk of mission drift associated with this trend, they also agree with several statements about the benefits of this trend, so the benefits of larger scale incumbent players entering the impact investing market. The third, fourth, and fifth bars show that most of the respondents actually agree that the entrance of these players will help professionalize the market, bring in much needed capital to solve some of the major capital gaps that we're seeing to address the world's social and environmental challenges, and then also enhance the credibility of impact investing. And as I mentioned in the beginning of my presentation, we're very excited to engage with this community, with others, to learn from some of your experience as well as responsible investors. And so again, despite a note of caution around the entrance of large-scale sort of mainstream players, there are generally very positive views on the entry of large financial firms into impact investing. And so we hope to see more activity from Endowments and really look forward to working with all of you and IEN, and also to try and provide you all with the necessary tools and resources to make it possible to consider and even allocate to impact investments. I should mention that we've recently launched a new initiative, a public initiative here at the GIN that supports institutional asset owners, including endowments, in accessing educational resources and evidence base, and also accessing peers that are already doing impact investing. And these resources are meant to help those of you who may not be doing impact investing yet to make the case for it and to learn about it within your own organizations, and then also to meaningfully participate in the market. And we see this again as a complement to existing ESG strategies. So we're here to help and look forward to hearing feedback from you as to what would be useful and also working with you going forward. Next slide, please. And we'll end our remarks for now, but we do encourage you to visit our website to access additional resources, including performance research. As Fran mentioned, we do have performance research on different asset classes like private equity, and the sample for the private equity benchmark is actually growing, and so the data is even more accurate. We've also recently launched a new performance research study on the financial performance of real assets impact investing funds. And so we hope that you'll check that out. And then we'll be releasing a new one on private debt later next year. So I'll stop there, but thanks so much for this opportunity.
Great, thank you, Allison. That was fantastic, and a lot of really good data there to help us understand what's happening in this space. And really looking forward to learning more about the institutional investor program. So now I'm going to turn it over to Sean Wishmeyer to hear a little bit from the Chief Investment Officer perspective about how to put some of these ideas into practice. Sean?
Yeah, absolutely. Thank you. So unfortunately, I'm not going to utilize slides, so you're going to be forced to look at a picture of me during this entire presentation. So apologize for that in advance. But a little bit about Margaret A. Cargill. We are approximately $7 billion foundation based out of Eden Prairie, Minnesota, so we're just west of the Twin Cities. Even though we have Cargill in our namesake, it's not to be confused with the Cargill Company, who owns and operates their own foundation. Our money did ultimately come from Cargill because our benefactor was the granddaughter of the founder, and when she passed away, she left all of her money to charity. So I'll talk a little bit about our program in a few minutes once I get into how we operate and what we do. But I need to make note that our investment program as a whole, not only mission-related type investing, ESG impact investing, but our entire program has only been around about 5 years. So I started with the organization 5 years ago, and we've ever since been building out the team to both manage the portfolio and to learn about and understand what impact investing means to us. So you're going to get a fresh perspective of a group that's only recently begun down this path. So when I talk about impact investing, I'm going to use the term MRI, or mission-related investing, a lot. Not to be confused with ESG or other terms that are utilized. The reason we use the term MRI, or mission-related investing, is because we are a mission-focused group. You know, we have very distinct program areas or domains, and therefore I don't want you to be confused. I may interchangeably say ESG, impact, or MRI. So when you look at our portfolio, what do we do? You know, we're charged every day with looking at this portfolio and not only making money, but trying to be consistent with our values and our mission in the implementation of our investment strategy. So as we've talked already on this call, you know, we break the portfolio up into publics and privates. And if you look at the private side, we've effectively if you look at the public side, we've effectively implemented negative screening. So I'm going to go back to what Fran talked about, you know, the 1700s. So apparently I didn't realize we're that dated, but we're still in the 1700s with implementing negative screening of our portfolio. However, by doing that, we do ensure that everything that we invest in on a direct basis, whether it be public equities or fixed income securities, will not be giving money to groups that we otherwise would not be aligned with from a mission perspective. So we do divest just under 10% of our portfolio, and you know, we focus on getting, you know, the worst actors out. So when we do divest, we focus on utilizing a third-party service to help us come up with what they deem to be the bad actors on a whole host of factors. Then in addition to that, we add on some additional things that we care about that may not be fully expressed through that third-party services definition of bad actors. And those include coal companies, oil sands companies, and tobacco companies. So we take the bad actors, we add on the coal, oil, and tobacco, and then we give all those lists to anybody that manages money for us. So we make sure that those items or those securities get screened out of our portfolios. Now, what's more interesting is the private side of the ledger. So private side, of course, would be anything alternatives, private equity, private real estate, venture capital. There, we've had a much more developed program over the last handful of years. First and foremost, we do as well focus on negative screening. The negative screening is just quite simply don't do anything that we don't want to be involved with. So when I talked about public equity or public securities, and I talked about coal, oil sands, and tobacco and divesting of those, well, if you translate that over to the private portfolio, then we certainly would not want to be investing in groups, for example, that specialize in the production of tobacco or specialize in drilling holes in the earth and pulling hydrocarbons out, upstream oil and gas. So we start out by omitting those investment opportunities from our sphere of, for consideration. And then the most exciting then is what I call the positive side of private market investing. And that's where we're focused on identifying and finding groups, for example, a buyout or a venture capital fund that has the ability to go out into the environment and buy and make better companies or strategies that are highly consistent with what we want. In many cases, we implement those strategies through fund investments. In some cases, we implement those strategies through direct investments into the equity of companies, which basically are set up as operating platforms to go out and handle whatever strategy that they've set forth. Now, on the fund side, you have to be careful because some funds may not have a very explicit goal of being mission related. They may be able to do that with the majority of their investments, but may have some things that they include into that fund that don't meet our criteria. But that's okay. We look at it and believe that if we find a number of investments, or investment managers or funds that have, the key criteria that we want, then over time, by expressing the majority of those into the portfolio, then we'll be able to have some level of positive impact. And then on the direct investments, that's a much closer tie, to us getting directly at the company or the exposure we want. And I'll share the names of some of the groups that we work with in a few moments. But I do want to note that just like Allison had talked about market rate all the way through non-market rate or concessionary, and I'll take that even further to talk about grants. Since we're a grant-making organization, when we want to give capital to a cause or to something, we've got to decide what's the best way to fund that. If we think something is going to achieve a good impact and will align with our mission, but we have no expectation of getting that money back, well, we have the ability to give them a grant directly out of the corpus of what we do. If we believe on the other end of the spectrum, for the investment portfolio, we're currently focused on market rate style investments. Now, we may consider some things in the future that are slightly below market rate, but at least for now, we've been highly focused on finding things that meet both our return hurdles and are highly tied to our mission. And fortunately, we found enough opportunity out there. We're believers that if you look hard enough and turn over enough rocks and join with enough institutions such as the GIN and others, then you can come up with a list of interesting investments. So in 2014, we set up a target to invest at least $100 million into these private market opportunities, these positive opportunities that were focused on our mission. So I'm proud to say that since that time, we're ahead of that schedule. All of our mission-related opportunities are focused on our 7 program areas, which are arts and cultures, quality of life, which includes children, families, aging services, animal welfare, both domestic and wild animals, teachers across all genres, and disaster relief and recovery all over the world, and then the environment. The final, our 7th area, is legacy giving, and it's things that were important to Margaret A. Cargill. So let's talk about the investments we've made thus far. Thus far, we've made 5 different investments in the private side. 3 of them are fund investments. The 3 fund investments include a venture capital fund and includes 2 wastewater funds. And effectively, each of the wastewater funds have different strategies, but they're both focused on taking materials that otherwise would go to landfills, trying to reclaim that, or taking process waste from, let's say, a chemical plant in China and trying to make sure that it gets cleaned up appropriately before it gets pumped back into the water system. 2 of the 5 are direct equity investments. One of those is to a company called Generate Capital, which focuses on clean energy infrastructure. So solar, wind, anything, some wastewater as well, just anything that would be clean energy on a decentralized basis. The 5th and final investment is our most interesting yet. It is a nutrition company focused on food for fish. So it's a fish food company. And effectively what we're doing is we partnered, ironically of all people, with Cargill in this case, to help turn turn natural gas feed sources into organic food for fish. So the concept there is that by not taking all the small fish out of the oceans, grinding them up into fish food to feed to fish farm fish, that will help, protect and save, the oceans and the waterways. So that's just some examples of the things we're doing. Final comments here I'll make, we're very active in a lot of conferences. We regularly take part in the Milken Institute, White House Clean Energy Summit, Mission Investors Exchange, the Global Impact Investing Network, Jen, Allison's group, Stanford Clean Energy Workshops, so Confluence Philanthropy, and there's a lot of other groups, that are out there. But the way that we've tried to learn about this very quickly is getting out and networking as quickly as we can with all these different groups. We take this seriously across our portfolio. So every investment we make, whether or not we consider it a mission-related investment, we do an assessment, an ESG or an MRI assessment on each opportunity. So if you look at the investment recommendation write-up for each one of our opportunities, you can see that we've opined or assessed whether or not we believe that they're being adequately focused on such issues, and or whether or not they're able to take such issues and potentially turn them into a benefit or a value enhancement, similar to some of the things that Fran and Allison had already discussed. Finally, what we're working on now is how to assess impact. And I think there are a number of groups out there, many of which that have been mentioned are trying to get it done. But for us, it's very important that we can assess what kind of impact we're having, particularly if we move down the path away from true market rate investments only. If we would start considering things for the investment portfolio that are below market rate, then it's critically important to us to say, what true impact are we getting? Because what we need to understand is, are we getting enough impact for the potential return that we're giving up? And if we're not, then we're not going to do that. Or potentially we'd fund the initiative, but we would do it through a grant. So with that, I will stop, turn it back over to George, and I think the next step is questions for all of the panelists.
That's right. Thank you so much, Sean. That was great to hear, and a very, very exciting journey you all are on. So I want to start with a question, kind of a couple of related questions, but we had one about how much of the growth in this market in the ESG or impact space is sort of a reclassifying of existing investments versus, kind of real new investments. And in a sense, that gets to this notion of intentionality that both Fran and Allison mentioned in terms of, defining impact as needing to have that intention for positive impact. And so, I'm always kind of curious, if two investors were to make the same investment, one with that intention and one just looking at it as a good investment without sort of a positive impact intention, how do we think about that and sort of classify it? So I think this would be great just to hear from each of you on. So Fran, maybe could you take a shot at that first?
Sure, happy to. Yeah, so there's this question about reclassification. And I think if you look at some of the bigger platforms like, Morgan Stanley a number of years ago announced their Investing with Impact platform. And they initially took the ESG funds that they had already approved and kind of bundled them up into a group and presented them as a platform. And you know what, I think that's fine to start. And now they have developed additional products and even a private equity fund of funds. And so I think that for the incumbents, it is a way to start. And I don't think just because they're kind of picking the ESG flowers in their mist and putting them together in a bouquet that necessarily means that it's less than. But I think what is also implied by this question is the quality of the ESG disclosure. Each of us touched on this a bit, and I'm sure there'll be questions about how you measure impact and verify impact. And I think a lot of ESG public company disclosure is self-reported and unverified. And so I think in the future, the bar will get raised. And I think that is one of the things that can stem the tide of impact dilution as we have more market rate and mainstream capital flowing into the field.
Mm-hmm. Great. Allison, anything to add?
Yeah, actually, my colleague Hannah Schiff will take this one.
Hi everybody. Yeah, so I think that I would take this in a couple of parts. One is that the point of looking for intentionality as part of the definition is that an investor can then manage toward it and maximize what they're intending to seek from a non-financial perspective, just the same way that you manage towards certain financial goals. Having said that, I think that probably many of you on the line, if you were to look at your current portfolios, there may be things that qualify as impact investments that you don't realize yet. But separately, in terms of the growth figures and what we're seeing in the growth in the market, I think from the research perspective, we feel pretty confident that it's capturing actual growth and not just a rebranding for a few reasons. One is, we can study the portfolios of, we now have longitudinal data, I should say. So if we look at portfolios of investors who have been in this space for a while, and over the past 3 years, they've had an 18% compound annual growth rate of their assets under management in impact investing. And so that's growth from, within active impact investors. Then we're looking at, beyond that, there are those who are joining the space and who are developing intentional impact investments and managing towards specific impact goals.
Mm-hmm. Good. And Sean, I think, it sounded like you all look at all of your investments in this way now. When you got started, did you kind of start with an assessment of your current investments and see what might fit, or how did you think about it initially?
Yeah, no, we did. And, probably the way to best characterize that is I talked about 5 different investments that are effectively in what we call our virtual MRI portfolio. But to be clear, we don't carve out any assets of the portfolio. We apply this lens to everything we do. So that same comment of, if you look at a number of our investments that aren't tied to those 5 I mentioned, any number of them have a very large percentage of their investments and portfolio that we would consider MRI or impact related. So I do believe that the breadth of what we're doing on this front is much more than just the headline, numbers I gave, both in terms of investments and dollars. So we do believe it's there. And we think, honestly, to get back to the nature of your original question, is it expanding? Are people going there? From our vantage point, the clear direction we got from our board and investment committees going out was to pay very close attention to this. A lot of us come from worlds that are outside of the foundation space, and we've been here for years now, but those weren't the same directives that we got in those other places. So I am absolutely confident to say that because of that direction, because of that focus, because of the push, we have many more or much deeper exposure, to impact or MRI investments throughout the portfolio than what we would have had there not been that initial focus.
Mm-hmm. Got it. And Sean, just to follow up with you again on another question around the opportunity set and what's out there. I think you mentioned that through some hard work, you're able to find plenty of options, but we've got a question about how difficult it is to find appropriate investments or investment managers in the impact area. And is it, is the general sense that there's a lot of capital looking for good opportunities and there aren't enough, or are there a lot of opportunities out there that we need more capital for?
Yeah, no, it's a good question. I get this question often, and we've been able to find enough opportunities to satisfy, what we've been looking for. But to be clear, a number of the opportunities tend to arise in the same space. So for example, the environment, wastewater, cleanup, we already have a couple, 2 to 3 investments focused in that area. So anything that we would want to have in like water related infrastructure investments, probably going to have 90 or 100% of that allocation focused on MRI. Whereas some of the other allocations in other parts of the portfolio, it may not be as obvious how we can go find mission-aligned investments in those areas, because certain areas of the portfolio don't lend themselves to such things. So that's one of the considerations. The second part is, what I always say is, there's plenty of money out there for the right opportunities. I have many people come to me and say, I've been shopping this thing around, I got this great idea and nobody will give me money. Well, is that a fault of there's not money available, or is that a fault of the offering? My view is, because most of us would be willing to give money to something that has a market rate of return and have a double bottom line associated with it, that's awesome. It doesn't matter whether that's your mission or not, just your heartstrings, you being a good human being would be biased towards things that have that double bottom line. I think if groups would focus more on packaging the offerings and the opportunities up in ways that make sense, then the money will be there. I think there's plenty of money there. It's more about people becoming more sophisticated as to how, they package and get things out there. So I think there's enough opportunity and there's enough money, but a lot of the people that complain about it usually haven't taken the time to evaluate or to correctly structure their offering.
Just to dig a little deeper on that, if you don't mind, what are some of the things that you see that, think this might be a good idea, but it's just not being communicated right or properly or in a sophisticated enough way? Is it,
yeah. So there's any number. I would say it's across a lot of spaces, whether it's clean energy or what we have yesterday, I sit down with a group, talking about, I want to do an app, to get out to individual people, to help them be able to discern, which are the better, companies and which are worse, and therefore they can invest in those companies. Something like that makes sense. And, it'd be great. I'd love for people to have access to that to help make informed choices in their own individual, stock portfolios. But when they come to us, just not prepared with how do we get involved. So for example, they come to the investment group going, hey, please put money in our funds, and be like, well, you're offering an individual app going out to people, but, we go hire, we have billions and billions of dollars in these accounts, so we go hire people to deal with it. That's just one recent example of where not everybody has thought through their business plan model. Really what that group needs, and it's a great idea, is grant money. They need someone to come in and help fund their business for a period of time to get to proof of concept to where it becomes more investable. I would say, just quite quickly, other things are new people that have never run a fund or run a business, and they come in and say, I'm really excited about all this mission related stuff, so I'm going to hang up my shingle, please give me money. Other things apply. We need to be able to see that you've managed a business or managed a fund or done other things first. So I think it's many fold. There's probably 100 different factors. It's probably not one that sticks out. I just think it's generically something people could do a better job at.
Great, thank you. And Allison, Hannah, or Fran, anything else on those sort of macro trends in the data that you see in terms of the opportunities that are sort of institutional investor ready?
Yeah, this is Allison from the GIN. I think we agree with Sean that we think that if you look hard enough, it's out there. And increasingly, with the entrance of new firms and the expansion of the market, you're not having to look as hard. There's more of the ecosystem that Fran was describing, and there's more resources for investors who are interested in this. And also the intermediary side of the market is growing as well. On the GIN side, we have a couple of resources that try to solve for this problem in combination with the investors. One, we have a database of impact investment products and funds called Impact Base, which is accessible to public accredited investors. And this resource is growing. It has over 400 different products on it. And there's something for everyone. And those that are targeting market rates of return. That segment is also growing on that resource. And the GIN also works through the investors, through the membership, to try and support some of the intermediaries who are marketing products to investors like Sean. And so we try to help them, along with the investors, to make sure that the products out there are responding to the needs of both investors as well as the underlying assets or the actual products where we're looking for impact. And so we're trying to build the market and solve for some of those gaps that we're seeing in that way as well.
I would just add on to that. I agree with what has been said. Especially on the private side, I always say that's called private equity and private debt for a reason. It's private. The markets are not perfect. It's very much about who you know. Many gatekeepers and institutional gatekeepers and CIOs and family offices are, it's a private world, it's a quiet world. It's based on who you know. So track record is king. As we were saying earlier, I think it's particularly difficult for women and minority fund managers who are somewhat disenfranchised from these private networks. I know that Ford, which is the host of the Alliance, they recently announced $1 billion carve out of their endowment assets for impact, and with very particular deep impact themes of affordable housing in the United States and financial inclusion in emerging markets. But there's an additional overlay giving thought and consideration to women and minority fund managers. And so just wanted to add that additional element.
Great, thank you. So we've got just a couple minutes left, but I want to try and, we've gotten a few questions about the public market side in terms of where you can find impact there, how to find managers that are active in that space. And, I've heard a lot about shareholder engagement being kind of where you can find impact in the public markets. And so, Fran, you alluded to that. I just wanted to see if you had any further thoughts in terms of how investors might think of that kind of beyond the negative screens to have impact in public equity part of their portfolio.
Sure. Yeah, so there are an increasing number of public fund managers who do a number of different strategies. And so there are those that do kind of more passive strategies and those that do more active strategies. And so for the passive folks, they may be looking at MSCI data and looking at terminals and making some judgments there. On the active side, there are fund managers that do really deep management engagement and shareholder action. And so it depends on what you're looking for. Some have the greater ability to customize a portfolio and pick, screen out and screen in, to Sean's point, based on your very specific mandates. I think the more active they are, the more they have a kind of set of convictions around the engagement with managers and the selection. I think with passive, sometimes it's easier to toggle on and off certain elements. And so it depends on what you're looking at. There's also a policy implication. Dodd-Frank the Congress is looking at Dodd-Frank reform, and the House passed, but the Senate will not pass something called the Choice Act, which raised the hurdle considerably for the ownership percentage required in order to make a shareholder action. And so that's something that the Alliance is monitoring and others are monitoring to make sure that we can still have that shareholder engagement and manager discussion as part of a key tool in the toolkit when we engage with the public markets around impact.
Mm-hmm. Yeah, absolutely. A very live issue there, and a topic for a whole nother webinar. Well, the hour has gone very quickly, and I think that's just a testament to what a rich conversation this is. And this was billed as an intro to impact, and I think we'll certainly want to have some follow-ups to go deeper on many of these topics. So thank you so much to our panelists for joining us today and sharing your insights. Thanks to all of you for participating and listening in. And again, the recording of this will be available on our website shortly. So we will send out a follow-up email to get that to you all. And thanks again. Have a great afternoon.
Thank you.